what should you do once it's gone? What if you don't have any more cash in the bank? So I'm going to lay out a few options and give the pros and cons. And depending on your situation, one might be better than the other. And the first one is sell investments in regular taxable accounts. So if you just have a regular brokerage account and you own stocks, just sell those. The pros there are it's pretty easy, pretty liquid. You'll get the cash pretty soon. The market is down somewhat. Maybe it's a good time to do some tax loss harvesting. You can sell a stock that is less than what you paid for it. Wait 30 days to buy it back. But if you don't have money, don't buy it back. But at least that'll reduce your tax bill this year. So that's a pro. It's pretty easy to get that money. The con is, ideally, you bought that investment as a long-term investment, and now you're going to have to sell it. And the market is down, and that's one of the worst. That's one of the reasons why you want an emergency fund, that you're not forced to sell stocks when they're down. Plus, if you are selling at a gain, you're going to owe taxes in a year. So if you sell an investment with a big capital gain, make sure you have a plan for paying those taxes. You don't want to forget about it and then be surprised come April 15th in 2020. Another option, of course, is credit cards. Credit cards are easy because everyone takes them. And if you are a federal employee and you do expect to get your money back, and they just did pass a bill that basically says once people do go back to work, they will get their pay, credit card is a good source of short-term money, and you just got to make sure you pay the bill off. Mm-hmm. Maybe get some points for airline miles or something like that. The cons are, of all the debt you could owe, this has got the higher interest rate. In December of last year, the Fed raised interest rates. But despite that, rates across the board in everything from treasuries to mortgages went down, with one exception, credit cards. Credit card rates went up, and they're now at all-time highs, according to creditcards.com.
Really?
Yes. So at least as long as they've been tracking it. So that's obviously the reason why you want to avoid credit card. It is a short-term bridge, but it is not a long-term solution. Another option is home equity. And for most people, that's a home equity line of credit. The pro there is if you've got the equity, you probably can get it. There's some setup costs, and you have to do a credit check and things like that, but it's usually not a big deal. And the interest rate is going to be much lower than what you pay on a credit card. The con of that is that you're basically putting your house as collateral, which is always a tricky thing. Also, due to the new tax law that was passed a year ago, the interest on a home equity loan is no longer deductible unless you use it to improve your house. So if you're using it to cover short-term bills, that interest is no longer deductible. So generally, I'm not a big fan of home equity lines of credit, but it's available. Another option, borrow from your employer-sponsored retirement account, your 401k, your 403b, or in the case of federal employees, the thrift savings plan known as the TSP. The pros here are that it's pretty easy. And even though it's called a loan, you're really just getting your own money. So there's no credit check. You don't have to get a credit approval or anything like that.
Rick and I know all about the
exactly.
401k
Well,
loan.
so you know how easy it is.
It was so easy.
Almost too easy.
It was so easy that when I asked Rick about any aspect of the process, he was like, I don't remember. It must have been really easy because I don't remember.
It is easy. And you're paying the interest to yourself, not to a bank. So those are the pros. And the most you can borrow is $50,000 or half of your vested balance, whichever is less. The cons are that money gets taken out of the market. So if the market takes off, well, in the course of this loan, you'll miss out on that. Also, if you don't pay off the loan, it's considered a distribution. You'll pay taxes and penalties if you're not 59 and a half. And generally, you have 5 years to do it. So again, it's a fine short-term solution, but you have to have a plan to pay it back. Because if you don't, not only will you pay the taxes and the penalties, but you're going to miss out on the future growth of what that money could have provided you if it were left alone in your 401k. Mm-hmm. I should say that there recently was a bill proposed to make it easier for federal employees to access the money in their TSP. I haven't followed the details yet, but know that that's also on the horizon for you folks out there at that. All right, another option. What about your other retirement accounts like an IRA? You can always access that money anytime. Interestingly, if you take that money out and get it back in within 60 days, it's like you never did anything.
Oh.
So it's a way, while you legally cannot borrow money from an IRA, people refer to this as the IRA loan. Take it out, you just got to make sure you get it back within 60 days. So just a note of caution, this is considered a rollover, and there are some rules about rollovers, including a limit to only one every 12 months. So if you've already done it once and then the next time you try it again, it's actually considered a distribution. You won't be able to put the money back in the IRA, and you may owe taxes and penalties. So make sure you learn all about the ins and outs before trying this strategy. Now, if you're taking money out of a Roth IRA and you don't get the money back in, the contribution you put in will still be tax and penalty free. It's any growth that you took out that you'll pay taxes and penalties if you're not 59.5. Traditional IRA, if you take it out and don't get it back in, you're going to pay taxes and the penalties. And of course, the negatives there too is the same with the 401k. If you don't pay it back, you'll have missed out on all that growth and your retirement will be compromised.
Or maybe the stock market tanks.
Well, that's true. Some people might
time it very well. So let's try to look on the bright side.
That's right. There's someone in the studio, in fact. Okay, and then my last option, borrow from family and friends. And this, if you are in a family where that's fine, and it's not embarrassing, and it won't cause any friction with folks, it's a perfectly fine solution. When I bought my first house, it involved borrowing money from my dad, who in the end just said, you know what, don't pay it back. You're just not going to inherit as much when I eventually die. But I was happy with that.
Yeah.
So that's a great option if you can do it. The cons of it are it can cause troubles.
Borrowing money can be very difficult with family,
right?
And keeping things fair,
right. And if you're not in a position of being able to pay it back, that causes problems. So
last resort, is that bro's last resort?
Well, it depends. I mean, if you have that family where people are generally well off and have established, like, listen, if you're ever in trouble, I'm here to help you out. I think that's the first resort. Mm-hmm. It's great it's probably an interest-free loan, and you don't have to go through all the other hassles.
No paperwork.
Right.
Not a lot of paperwork.
Right. So it just depends on your situation. So there you have it. Building an emergency fund is the most boring of financial planning advice ever, because sitting on a big pile of cash just isn't very exciting. But right now, there are hundreds of thousands, if not millions of Americans who either A, wish they had built an emergency fund, mm-hmm. or are very happy they did. Regardless of your situation, having one, I think, is an important part, really the foundation of a good, solid financial plan.
And what's your advice, though, for, like you said, those who are furloughed will eventually get back pay? So there will eventually come into a big pile of money.
Right.
Do you have any advice then?
Yeah, well, so obviously, if you've borrowed any money to do this,
pay it back.
Pay it back. If you've stopped contributing to your IRAs, 529s or something like that, get back on that track. I think there actually could be a silver lining to this, in the sense that if you go without a paycheck for a while, it really forces you to prioritize your budget. And I think it's very possible you eliminate expenses that you thought were important, and then you realize, you know what, actually, I don't really need that. Mm-hmm. So once you're back on firmer footing, consider maybe I don't need cable anymore, or maybe I didn't need this service, or maybe I didn't need the gym membership like I thought that I did. But then once you get that cash, don't go nuts. Don't be feeling like, I got this big check now, I'm going to go on vacation or anything like that. The number one priority, obviously, is to build up that emergency fund.
So start listening to this podcast episode all over again.
Right.
Just rewind, and then it's this virtuous circle.